It's about 50 feet. 50 feet.
I'll do my best not to bore everyone, and I want to make it clear that I do have other interests in life besides this. As we start ramping up for our 2017 filing season, it's amazing that from mid-December on, we've been getting more questions about 2018 than folks being interested in getting 17 out of the way. So what I'd like to do, in more of an overview as far as what's happened in the individual side and the corporate side, but very little touching on the corporate side, because the individual side affects everyone here, is to kind of walk you through, can you hear me? Is kind of walk you through what's really happened as far as loss of deductions, reduction in tax rates. And as Roy mentioned earlier, there's been a lot of press out there with regard to the loss of the state and local tax deduction with regard to property tax and income tax. And it's gotten, a lot of people in the tri-state area especially that have a high tax burden upset with regard to, is my tax bill really going to go up through the roof if I'm in a high taxing jurisdiction? So what I'd like to do is show you a few slides here with regard to what's happening. It's more of a summary than anything else. And I guess I want to impress upon everybody that everybody's situation is going to be different. And, we'll try to present everything here, but as far as trying to identify what one person is up or down with regard to it, you want to see that? Right now on the, notable individual changes that many of you have probably heard, on TV and read online, is certain changes that we've had with regard to the individual rates. There's always been 7 brackets, they've been retained, but what we've found is all through the tax brackets, which had earlier capped at 39 or so percent, they've kind of been reduced around 2% throughout the range. What's new for this year is the standard deduction has increased substantially from $12,000 for single filer and $24,000 for married filing joint. The intent on this whole thing, as far as Uncle Sam is concerned, is to put a lot of folks in that standard deduction category. In that regard, it's really will simplify many returns for 2018, because with the elimination and the capping of the state and local tax deductions, a lot of folks aren't going to get to that 24,000 range in 40 or so states in the U.S. So in summary here, the personal exemption side has been repealed. Those exemptions are gone away. We've also, we'll see a child and family tax credit increase from $1,000 to $2,000, and I'll go into that later. Another item in here that's gotten a lot of press has been the limit on interest deduction for mortgage interest, which prior to 2018, the cap was $1 million of debt. For 2018 going forward, it's been moved down to $750,000 of debt. And in addition to that, they repealed the deduction for home equity indebtedness. So those equity loans that people were adding on to their original mortgages, you're not going to get that benefit. The cap of $750,000 on acquisition indebtedness on purchasing a home, that's a cap of $750,000, but it also includes a second home. So what you have to keep in mind, let's say you have a $500,000 mortgage on your principal residence, and you want to go out there and buy a second home, and you've got a $300,000 mortgage on that vacation property, you're going to be capped at $750,000 as far as the interest deduction with regard to that, so it's going to get haircutted. The SALT deduction, the state and local tax deduction, is, as I said, getting a lot of press. Your state income tax and your real estate tax on a combined basis cannot exceed $10,000. So that's going to put a lot of folks in that standard deduction. Another item is the AMT, which has affected a lot of folks in that, your combined income in that 225 to 250 range. A lot of folks were paying tax based on the alternative minimum tax, which was basically if you had a high state and local tax deductions, a lot of those state taxes weren't getting deducted anyway because the AMT calculation did away with it. For folks that are familiar with the overall limitation on itemized deductions, if your income was in that 300 to 310 range, you might be out there with $50,000 of itemized deductions, but if your income was over a certain level, it was reduced anyway. Here is a table with regard to where the tax rates were in 2017 and where they are in 2018. And if you kind of move across, I know folks in the back can see, you've got 100,000 going up to 800,000. And if you go across, you'll see that 200,000 range, which was a 28% bracket in 2017, is now going to be 24%. Where the big plus is, if you're in that 300,000 to 400,000 of combined income, what was a 33% rate, you could be down to, you're 32. So that's a comparison side by side, and that's the reason I'm bringing this up is with the loss of deductions. I think what they ended up doing is with the elimination of the itemized deductions and the exemptions, they built the tables in with a reduction all the way through, and I think it's going to compensate for that. This is just a quick screen here with regard to comparing 2017 and 2018, where the standard deductions were in 17 compared to what the 2018 rates are. One thing I do want to mention, the exemptions that folks were getting at 65 and over, they basically added it to the standard deduction category. So let's say if you've got a joint return at 24,000 and both of you are over 65, you're going to get an additional, $2,600 of standard deduction, which is going to put you in that category. With regard to the deductions the exemptions that have gone away, they did bump up the child care credits to compensate for that for folks that were losing 3 or 4 or 5 deductions, depending on how many children you had. And this is the increase with regard to credits, 1,000 to 2. Credit for other family members, which have never really existed, is at 500. And the phase out, meaning that based on certain deductions getting reduced, has gone up substantially, which in earlier years it might have been pretty easy to get into $110,000 of phase out range. One thing also is that it's a refundable credit. Certain credits in the past, they were not refundable. So if you didn't have a tax liability there and you generated a credit, you really got no benefit of it because they weren't going to give you that money over and above. I want to touch on briefly on the Section 529 plans. One item that was new for this year is you're able to make distributions out of that 529 plan up to $10,000, and they can be used for non-college tuition. It could be for elementary school, high school, Montessori school, or any private situation. The other item on Roth recategorization, you can't really unwind a Roth conversion after 2017. And our investment folks there, that's something that's going to affect a lot of the planning going forward with regard to Roth contribution and what you can do as far as moving it between a Roth and a traditional IRA. And there's a little blurb in there as far as experts are debating whether you can do certain things, that 9100 relief. I won't bore you with that. But it's basically, you know, they introduced the tax bill the last week of the year. You know, it was thrown out there, and the IRS is still behind the curve as far as issuing guidance on a lot of things that, you know, were thrown out to us. Here's again a recap of the state and local deduction up to $10,000, the mortgage interest, charitable contributions. You know, the limitation in the past was that you could give charitable contributions up to 50% of your income. That's been bumped up to 60. The medical expense threshold was either 7.5% or 10%. Now, any medical expense over and above your adjusted gross income of 7.5%, you're able to take it. Personal casualty losses. You know, that's something that no one wants to wish on anybody, but in a situation of all the hurricane disasters that we've had over the last year or so, that casualty loss deduction, which is one of your itemized items that you don't see very often, they repealed it, but they're basically putting an exception in there if it's a declared federal disaster emergency. It's an item that you can take. The job expense and miscellaneous deduction category, all that is got 2% items that fell in the bottom of that itemized form that everybody looked at. That's gone away. In addition, and we've had a client here that was really upset about the alimony paid situation. Alimony is the deductible expense. That no longer is going to happen. But at least they used some wisdom, and they grandfather clause. So it only affects executed instruments after 12/31/2018. Because had they made the change, you know, everyone would be out there renegotiating their, you know, divorce contracts. Moving expenses. You know, you're always allowed to take any income that you received from your employer and associated with a move was essentially tax-free if you use those monies for a move with regard to relocating. That's gone away. Again here, the AMT was that, you know, that hidden tax within the federal tax system that kind of disallowed state and local taxes if you got over a certain level to make sure that you had some type of liability. That's essentially going to go away because once the state and local deductions get capped, this is going to affect the, you know, 0.5% of individuals. Here's another pretty table here. Between single and married, as far as where the tax rates are based on your single and married combined income. And the colors there, if you can see it, down below, you'll see where the capital gain rates are falling with regard to those incomes. It's still the 0, 15, and 20% category. However, the rates have changed a little bit. They no longer tie in exactly what the ordinary rates are, so the amounts are different. The 3.8% cap for the very high income individuals that are in that 37 bracket are still going to have that additional 3.8% investment income tax in addition to the 20% rate. I wanted to touch on lightly with regard to what the state of New Jersey has done and is doing going forward. And this affects a lot of folks in the room here, just from the returns that I've, you know, crossed my desk over the last, you know, several years. You know, New Jersey is is losing a lot of folks to states that have traditionally exempted retirement income. I mean, Pennsylvania itself is totally exempts all type of retirement income. So there's been a phase-in of a higher deduction with regard to retirement income. So for instance, in 2017, if you were married filing joint, your first $40,000 of retirement income is exempt for state purposes. And keep in mind, that number has nothing to do with Social Security, because Social Security, the state of New Jersey has never taxed Social Security. So if you got IRA distributions, you have pension income, that number falls within that category that's getting pushed to 100,000 full exemption in 2020. Unfortunately, the way the state wrote the law, if your overall income is over $100,000, you lose the deduction completely. So one thing that we've tried to do is managing folks' income with regard to IRA draws and distributions is to keep that number under $100,000 if you can. And everybody's situation is different. For instance, if your income comes in at $100,001, you lose the whole. In the case of 17, you would have lost the whole $40,000 of exemption. So at a 5% rate for $1, you could lose a $2,000 tax bill. And in the wisdom of the state of New Jersey, that's how they wrote the law, as opposed to trying to phase out the deduction if your income increased. One item that they did, let me go back. One item that they did make some sense on, and I think I have another future slide, is let's say in 2018 you have 60,000 exclusion, but your retirement income is in that 30 or 40 range, and you don't utilize the entire 60,000. It can be used against other income to a certain level, depending on whether it's wages or other income. So you're getting basically a deduction up to that dollar amount, but if it's not utilized on the retirement income portion, it can be utilized on certain aspects of other earned income, wages or whatever. I put together a scenario here trying to compare, because a lot of questions have come up as we put together some folks' put together some 17 returns. Where's the side-by-side comparison and where am I going to be? Here's a married filing joint with both individuals over 65, and I'm just using $150,000 of total income, $10,000 in wages. We have some unearned income and interest and dividends, and for illustration purposes, I have IRA distributions of $25,000 and pension of $60,000, and Social Security. So on $150,000, here's your income, the same for both years. If I move on to my next slide, I did an illustration here with regard to itemized deductions. As I said, it's been getting a lot of press. That $700 number for income taxes is actually $700 liability for the income that I showed in that previous slide based on what New Jersey does. So here's income taxes and property taxes under the old rules. You'd have $7,000, $14,000 in property taxes, which maybe in Hunterdon County could be 14, could be up to 20. Mortgage interest, if you're, let's say, a person who's at the tail end of their mortgage and their interest is relatively low. Itemized deductions in 2017, you were at $23,007, but based on how they wrote the new law, that income tax and that property tax component gets capped at $10,000. It's, on the surface, you look at it and say, oh my God, where am I going to be? Everything else, if you bring it down, you'll see, if you go down further, you'll see the standard deduction for each 2017 and 2018, and then I layered in the increase being both over 65. So, set 2017, the itemized deductions were at 23.7. In this here, it's beneficial. You have a standard deduction of 26.6, and that's, as I said earlier, it's going to push a lot of people into that standard deduction category. In calculating that exact scenario for the $150,000 of liability, taxable income is increased. In this case here, with regard to the old way versus new, I'm at $118,002 versus $123,400, and you're saying, all right, my income has gone up, but because of the drop in the rates, in this scenario here, the liability is down. I mean, you're at the marginal rate of 22% with an effective rate of 15%. So, like I said, it depends on your particular situation and where you fall in the tax rates to really determine where you're going to stand based on the change in deductions and exemptions and your rate. Here's another situation which, on the high end of $500,000 of income, keeping that neutral, with substantially higher income and property taxes, in which this person here, itemized deductions were close to $69,000 under the old rule. And what I haven't read there is that phase out that's always existed based on if your income was over a certain level. You never really got that full exemption. Going down to here, the itemized deductions on here, it was a substantial drop from $68,900 to $32,000. However, you know, if you start putting the numbers together and you find out that your rate has dropped considerably, taxable income was at $431 and $468 respectively, and you'll see that this also turned out to be a favorable down. Now, I'm not saying they're all going to be this way, okay? A lot has to do with your nature of your income, whether it's coming in as ordinary income or capital gains, because if you were paying at high rates and your rate moves a little bit more because of the change, you may see a significant difference. This is going back to state of New Jersey. This is what I started speaking about earlier, that if you don't utilize the maximum pension exclusion, and you qualify as 62 and over, and and you qualify as being your total income less than 100,000, you get to utilize a portion of that exclusion against other income. A little quicker, let's go quicker. Let's go back to E here. Let's see. Now, this is one item that's new for 2017. New Jersey added a $3,000 exemption in addition to your normal exemptions on your return if you're a veteran on with discharge. And that's for a 2017 item. That's what returns we're just doing today. Let me go back. One thing I do want to bring up on this, New Jersey is requiring veterans to send in a form and apply for that benefit even prior to filing the return, and which is pre-certification. And I don't know how in the world they're going to match this up behind the scenes, but that's what they've asked to do. If you haven't filed it and it's new to you, give us the application, give us your DD 214, I guess it is, your honorable discharge form, right?
Right, you got it.
Norm educated me on that. Give us those two schedules. We can attach it as a PDF file on the electronic filings, and we'll go in with the return. The business side, I'm going to touch on it very briefly, just to make you aware. The old rates for 2017, there were graduated rates up to 35%. The new rate is a flat 21% rate. An item that's going to affect a lot of folks here is the business pass-through. In order to keep small businesses equitable with the large corporations that are getting that 21% tax rate, they had to do something with certain businesses that are either sub-S's or sole proprietorships that, when you file your 1040 against certain Schedule Cs and certain businesses are going through there. So they had to do something to try to make that more equitable. Unfortunately, they broke up two classifications of industries. One to match the non-service industries, to match what they wanted to do with the corporate side as far as the manufacturing sector, and the other part was the service side. For businesses, the accounting, all the consulting businesses, medical field and everything else falling into the service business, unfortunately they put caps on there saying that if your overall combined income on your return was $315,000, there was a deduction phase out in which they reduced that 20% benefit. And anything over $415,000, you lost the benefit completely. What they're trying to do is get the non-service businesses to get that benefit. You're out there, you make widgets, okay? You got famous widget thing, is that you'd be getting that benefit. Now, there's other phase outs and other things that take into account on whether you can get that full 20%. That part of it is modeling, and that's something that everybody's situation is different. And that's something we can do for you with regard to folks that have that business. So that essentially is going to drop down the rate substantially if you get that full business. So if you have $250,000 of income at 20%, that's a $12,000 savings. And this is a definition of what they consider specific businesses. It's something that we can go over with you and discuss it, but it is essentially what they consider a service business and what is not. And there are some specifics and things that they threw in there. If you have any questions on it, feel free to give me a call, send me an email, and saying where do I stand. But let's do it after April 15th. This is the phase-out threshold. And I'll lead into what Mary's going to be talking about on the estate and trust. It also affects the estate and trust pass-through and everything else. But a lot of this is new. We haven't gotten a lot of guidance from the IRS on a lot of this thing. And we're going to be seeing a lot of things that we're going to be sending out to folks as we get it. And here's the estate plan. Hello, Mary. Thank you.
Can everybody hear me?
You're good.
Okay. Well, there's one bit of big news, the change in the federal estate tax, and that's that the exclusion amount doubled to about $11 million a person. So right now, if you die right now, and you're married, a married couple can pass about $22 million to their heirs, free of federal estate tax. But there's two takeaways with that. There's two takeaways. One, that estate taxes should never drive your estate plan. There are many, many other reasons why assets get lost and never get to your intended heirs. I mean, estate planning has one goal, and that's to get the assets that you've accumulated during your lifetime, that you've worked very hard to gather, to your intended heirs at the least tax and cost, the least possible tax and cost. Just focusing solely on estate taxes may not accomplish that goal. For example, if you have a child whose marriage might be a little bit rocky, you may want to leave their share of the estate in trust. That has nothing to do with estate taxes, but it's still a valid point from an estate planning point of view. So when we look at estate planning, we don't just look at the taxes. However, this is a huge change in the tax law. But what's an even bigger change is they did not repeal the estate tax. They basically had this opportunity. I'm not going to get political, but there was an opportunity to repeal the estate tax. And it's significant, in my opinion, that the tax was not repealed. Everything else stayed the same. The rate stayed the same. There's still 3 taxes. We still have this awful generation skipping transfer tax that nobody really understands. But we have it, and what that really is that if you try to leave your assets to your grandchildren, you get smart and say, oh, I'm not going to leave it to my children, I'm going to leave it to the grandchildren. well, they get you and it's still taxed. Also, this new higher exemption does go away automatically in 8 years. But again, what's even more significant is it could go away sooner. As administrations change, the tax laws can change. Like everything else, unfortunately, estate taxes, which was something that was pretty stable for many years, it was always $600,000 was the exemption. You do your will, you put it in the vault, you never have to look at it, it's done. Sometime around 1998, when the internet, I think, came into being and got popular, estate taxes started to change. And historically, the exemption has never gone down. It's always only gone up. But that doesn't mean anything anymore. History doesn't necessarily hold true anymore, and it is possible that the exemption could go down, and it could go down dramatically. We just really don't know. So what does that mean? It really means that your estate plan has to be flexible. There's two things. One, it has to be flexible because you really don't know when you're going to have to file an estate tax return. So you need to kind of put a plan in place that's good for, at least some time. And secondly, you need to review your plan. You really do. Especially if you had your will done back in the 90s or the early 2000s. If it's more than 15 years old, it very likely contains something called a formula clause, which was keyed into the exemption amount. Say it was back in 1997, it was $625,000. If you died tomorrow and the exemption amount's $11 million, it may go to places that you don't want it to go. One of the good news about even though the exemption is much, much higher, they actually kept this thing called step-up in basis. And the other impact of this new tax law is now estate taxes and income taxes are integrated. You really can't do estate planning without also looking at income taxes. And it's a good thing because when you die, your assets get a step up. Hopefully, they've gone up in value. You've done a great job investing them, and now you're worth more. They were worth more than when you bought the asset. So what happens is you get this step up in basis so that your children, when they sell it, they don't have to pay any capital gains. So there's this trade-off always between focusing on the income tax benefit and the estate tax benefit. And those are the twins, and that's why we do estate tax. That's why we do the estate planning. So quickly, there is this opportunity to give away this excess exemption. See those years from 2018 to 2085, we have this extra exemption amount. You can actually make lifetime gifts. And one thing you might want to think about doing is something called a dynasty trust, where you put assets in trust for future generations, and they're never subject to estate tax. So that's a great planning technique, and you have all this excess exemption to use in order to do that, and we can help you with that. The other major change in the estate tax world is that New Jersey, for today, has repealed its estate tax. As of January 1st, New Jersey no longer has an estate tax. So for a long time, we had to deal with this relatively low exclusion amount of $675,000. So if you died and you owned more than that, your estate would have to pay estate tax. Now, the rate was always much lower than the federal rate, but it was it was a tax that people had to pay, and now it's repealed. But many, many professionals and estate planners believe that it could get reinstated. And the problem is they've done this in the past where they've reinstated estate tax retroactively. So back in 2004, they made changes to the law retroactively. So I actually handled an estate that the person died in February with a non-taxable estate. They changed the law in July, and suddenly the estate had to pay tax. And we tried to litigate it, but it really wasn't worth the money to try to litigate it. So again, two major points. You have to review your plan and make sure it's flexible. The good news though, New Jersey doesn't have a gift tax. See, the federal, they're a little bit, they're more integrated. They have you can't give assets away to reduce your estate tax. In New Jersey, you actually can do that. You can actually, so as of right now, they don't have a gift tax. So you actually can give assets away. But you may not want to because of that, remember I said that step up in basis. So again, we have to always be looking at the income tax consequences, the estate tax consequences, whether it's New Jersey, should you move, if they reinstate it, should you move out of New Jersey? Maybe, possibly. You know, there's a lot of considerations about whether you should relocate out of New Jersey, cost of living, and we can always do that analysis and help you with that analysis. We really don't know what's going to happen with the estate tax, but for today, it's repealed. Now, New Jersey did not repeal its inheritance tax, which actually does generate a bit of income for the state. It is an income producer for the state. And that's an inheritance tax, is a tax on transfers to certain beneficiaries, like nieces and nephews or brothers and sisters. Class A beneficiaries are exempt. They've added that category of stepchildren, but step-grandchildren are Class D. The stepchildren themselves are Class A. The rate is not that high. The highest inheritance tax rate is 16%, but it does have a very low exemption. Like, for example, if you leave money to a niece or nephew, if it's over $500, the entire thing is taxed at 15%. Or if you leave a substantial amount, it's taxed at 16%. There are some ways to reduce this. You could make lifetime gifts, but for inheritance tax purposes, there's a 3-year look back. So you have to be very careful if you're going to make gifts just to reduce inheritance tax. If you have a large estate that you're leaving to these different kinds of beneficiaries, you may want to think about moving out of state. Because it depends on where you live when you die, if you're a resident, you know, if your estate is subject to inheritance tax, not where your beneficiaries live. So to just do a really quick summary, the federal limit right now we said is 11 million. It's very high. It's scheduled to go down to 5 million, back to 5 million. It could go lower and sooner if administrations change. So, you know, I think that we should all be mindful that, you know, we should have a good plan that might take that into account. New Jersey is repealed. It may be reinstated, and the inheritance tax is still in place. Pennsylvania does not have an inheritance tax, an estate tax. It does have an inheritance tax even to children. So again, when you're looking at possible states to relocate, you would have to keep that in mind, that if you move to Pennsylvania, your children will pay 4.5% inheritance tax. There's about, I think I added up 19 states that have some sort of estate or inheritance tax. They're mostly in the Northeast, Massachusetts, Connecticut, New York, New Jersey, Pennsylvania, Maryland, and then, believe it or not, there's actually some out in the Northwest. Washington and Oregon seem to also have estate taxes, and a few in the middle. Most of the Southeast and Southwest, they don't have any sort of estate or inheritance tax. So with that, I think I'm done with my presentation, and we will take questions.
Can I be heard? No.
So I'm going to thank Mary and Joe for their insight. One thing we're going to do, the screen, I mean, I was in the back and I have glasses which I have to get redone soon, because I couldn't see the screen either. So for everybody attending tonight, we're going to email copies of the presentation. It may take a couple days to get approved from a compliance standpoint, but we'll give copies of the slides to everybody. One thing I'd like to offer up, after April 15th, Joe, you heard me say that. If you want us to look at what your taxes are going to be next year and do an estimate, we're happy to do that for you and do a comparison, but after April 15th. If you're a tax, Sarah is shaking her head yes. You don't want to make the baby come early, do you? But if you come in earlier, it's challenging during, we call it tax season. We have football season, now we have tax season. So after April 15th, we're happy to do any kind of estimate for next year. And as Joe told me, this year, for those of you who do the tax return, it's actually going to provide a comparison if your income and everything's the same, what your taxes would be under the new tax laws. So that will be provided to everybody whose tax returns we do. One thing I'd like to ask is that if you have all your tax documents, please send them in, or call Sheree and schedule an appointment to come in so we can get after the tax season as it's happened. I mean, some clients are just finishing getting their information now. So we appreciate that, and we'd like to take some questions. Yes?
In 2017, many of us prepaid our property taxes so
Yes.
that they'd be deductible, or 2018 now, so they'd be deductible in 2017. The last I heard on that was that the assessed amount would be deductible, which in New Jersey would be 2 quarters. Is that the situation?
That's been, can you hear me? Am I on?
Yeah.
Hold on.
The assessed amounts, with the IRS came, when the tax code changed in last week in December, and everything was out there saying, okay, everybody's rushing to the local tax assessors and collectors for property taxes. There was no guidance at all on it. So here in New Jersey, New York, the metropolitan area, if the tax bills were determined and there were amounts due and amounts established, first and second quarter, I believe you're not going to have any issues with regard to getting that deductibility. And what ended up happening is, the last week in December, they came out with the tax code, and there was no guidance at all from the IRS on what items could be deductible as a prepayment and what could not. We didn't get, those things didn't come out until mid-January and later. We had one of our clients in Florida that the local assessors, they weren't even accepting payments for the following year. Just the way, they weren't even set up with it, they didn't even have an amount established. But the first and second quarter, I don't see having any problem with regard to that. One thing you have to keep in mind, though, is for many individuals, once you bump up that state and local tax deduction, $10,000 tax bill, and you put in 2 more quarters, you may be, in 2017, part of that alternative minimum tax phase-out, that unless you run the numbers based on what your income is in relation to deductions, you may not get a portion of that. And that's something you have to keep in mind. We're hoping, as Roy said, come April going forward, there's going to be a lot more guidance from the service with regard to what you can and cannot do. We did have many folks that went out there and prepaid. And on some folks, we had the opportunity to run some quick plans and estimates to see if they were in that alternate situation. And some folks, some of those folks, we basically said, don't bother, because you're not going to get it anyway.
Okay.
So that's essentially it.
Next question. Yes.
Your car credit's still there.
The electronic, the EV car credit of $7,500. What's that credit with regard to hybrids and plug-in electric vehicles? It's still there. One thing you have to keep in mind is it's a moving target with regard to what vehicles actually qualify, and it's almost on a manufacturer's basis, but it is there. But it's moving away from the hybrid side to fully electric vehicles. Yes?
So,
Hi, Laura.
along with that, I actually emailed you, I got something back, Joe, and thank you so much. PSE&G, for everybody in the room that is a PSE&G customer, just was offered a $10,000 actually the tax credit. So if you
Right.
could just explain. to
Keep in mind, and I'll,
That's new to me.
thank you for reminding me. Lauren.
Thanks, Joe.
The tax credit is a credit against tax that you've paid, or what your liability is for that particular year. So if BMW has an electronic vehicle and the maximum credit is $7,500, but we do such a great job in tax planning that your tax bill for the year is only $3,000, you can only take up to the $3,000 liability. It's not something that you can carry over to a future year. And, but the credit is still there.
Thank you.
Thank you.
Any other questions? Yes.
Interest on home equity loans.
Yes.
You said it was no longer deductible, but I read somewhere that it was, the home equity, if it was used for home improvement, that it would be deductible. Do you-
Everything that we have
Right, so-
seen has been on acquisition debt, Frank. And that's the terminology that they're using, it's that total acquisition debt. So if you, for folks that maybe in the past were getting equity loans to do certain additional work or addition on their home, I think it's gonna come down to actually, that's gonna go away. And that's where that 750 cap is coming in. Acquisition debt needs to be 2 properties.
All right, we have one, Sherry, right in the middle.
This is for Mary. Would you just give us some more detail? What's the difference between an estate tax and an inheritance tax? I'm not sure what you're defining for.
Yeah, an estate tax is based on is a tax on the assets that you own at the time of your death, you either own or control. So you think of it, your gross estate is this big net. Because it's not even, sometimes it's not just assets that are in your name, it's jointly owned assets or assets that you used to own but you still use. So that's an estate tax. That's based on your gross estate. An inheritance tax is a tax that the people that you give the assets to actually are liable for. Like say you leave $10,000 under your will to your niece, that's a transfer tax. So they do work like in New Jersey, you do get a credit. You pay whichever is more in New Jersey. So you actually, when we had an estate tax, if you paid some inheritance tax, which was that transfer tax, you would get a credit against the estate tax for any inheritance tax you paid. But the inheritance tax, legally, it's actually the people getting the asset that are liable for the tax. Most of the time you write in your will that the estate pays it, but if you don't have that in your will, then the people getting it. Which can be a problem again, I don't want to go on, but if you leave your IRA, say to somebody who is a Class D beneficiary, that could be a real problem because they suddenly 8 months later, they have this huge tax liability and they might have to take money out of the IRA to pay it. So that's kind of the planning.
And then they pay income taxes on the money they take out of the IRA, and have to take more money out because they have to pay the income taxes.
Right.
They have to gross it up, so it ends up being challenging.
Then they go bankrupt.
Yeah.
Yeah.
So that's why we look at every, the assets as well as the documents.
Any other questions? Yes. Just raise your hand.
Just to follow up on that one question, is the inheritance tax paid based on the residency of the recipient or the person who died?
It's the person who died. It's the relationship to the recipient, but if you're a New Jersey resident, your estate is subject to inheritance tax, regardless of where the beneficiaries live. Or if you live out of state and you own a house in New Jersey. So say you live in Florida, but you still own a New Jersey house and you leave that to your brother or sister, that would be subject to New Jersey inheritance tax.
We have one right here.
Is private disability taxable income?
I can answer that. It depends if it's individual paid or company paid, where you take a tax deduction.
Individual.
Then it's not taxable in receipt if you pay it yourself. But if you pay through payroll and you take a tax deduction for it, you know, you do it, so you get the deduction, then it's going to be fully taxable. So we recommend that you don't take deductions for disability insurance.
I've been solicited by the college that I went to donate my RMD. Could you explain how that's going to be affected, if at all? with the new tax law?
Jack, I don't see any change on that at all, as far as the...
Explain exactly what it does differently than just a regular, contribution.
How it benefits.
Well, what you're able to do is you can make a direct transfer of a required minimum distribution to a charitable organization, and the monies can go directly to that organization. It doesn't become part of your itemized deductions, first of all. Second of all, if you have a RMD that's held, had a stock, and you have appreciated property, let's say you bought some stock and it's located and it's invested in your IRA, and you know that if you end up selling that stock, you're going to have substantial capital gains. You can donate that stock at the appreciated value to the organization and not get hit with the appreciation and paying tax.
That's out of the IRA.
Is that correct?
So that deduction is any different than any other charitable deduction, or how does that, they were making it sound like it was different. but I-
Well, it's different because it may fall without, that's something that I would need to look into, but that 60% limitation, that may be part of the item that may be excluded if it's directly from the RMD.
All right, we have time for one more.
Last question.
Oh, wonderful.
Nobody? All right, I have a couple comments.
Thank you.
Thank you, everybody. Comments and observations. New Jersey is not an